HMRC compliance checks explained in 2026 what gets you flagged in the UK. If you run a limited company in the UK, this is something you really need to understand, because HMRC compliance checks don't usually start with anything obvious. They don't start with fraud. They don't start with someone doing something extreme. Most of the time, they start small. A late VAT payment. A number that doesn't quite match. A pattern that builds quietly in the background. And then, one day, a letter lands. Now, just to clear something up straight away, HMRC isn't spying on you personally. They're not watching your day-to-day life. What they are doing is looking at the information you already submit. Your VAT returns, your payroll, your company accounts, your personal tax return. And they're checking if it all makes sense. So in this video, I'm going to walk you through how HMRC compliance checks actually work, and more importantly, what tends to get businesses flagged. We'll cover 5 key areas. First, what to do when HMRC contacts you. Second, the patterns that quietly trigger checks. Third, how time to pay can sometimes create problems. Fourth, why directors' loan accounts often cause issues. And finally, why being a small business doesn't mean you're ignored. If you understand these, you'll be in a much better position to avoid problems before they start. Let's start first with what happens when HMRC actually gets in touch. What to do when HMRC contacts you. This is where most go wrong. This is usually the point where people panic. You open the letter and straight away your mind starts racing. What have I done wrong? Is this serious? And then you react. Most people fall into one of 3 traps. They ignore it, they rush a reply, or they guess. Now, all 3 are understandable, but none of them help. Ignoring it just delays things, and usually makes it worse. Rushing a reply often leads to mistakes, and guessing is where real problems can start. Because HMRC isn't expecting perfection, but it is expecting consistency. So if you send back figures that don't match what's already been filed, that's when things begin to expand. Let's say HMRC asks about your turnover. You quickly reply with what you think it was. But that doesn't match your VAT return. Now, instead of clearing things up, you've created more questions. So a better approach is simple. First, pause. Second, gather your records. Third, check what's already been submitted. And then, respond clearly. And if you're unsure, it's always worth getting advice before applying. Because at this stage, most checks are still fairly manageable. It's usually how people respond that makes the difference. Now, here's something else worth knowing. Not every HMRC letter is an investigation. Sometimes it's just a check or a request for clarification. But how you treat it matters. If you treat it seriously early on, you often keep it small. If you brush it off, or handle it casually, that's when it can grow into something bigger. A good way to think about it is this. That first letter is often your chance to sort things before it escalates. So don't see it as a problem straight away. See it as a warning sign that needs handling properly. The second thing we're going to talk about is what actually leads to that letter in the first place. The patterns that quietly trigger HMRC checks. Because it's rarely one big issue, it's patterns, and this is where a lot of directors get caught out. They think it was just one late payment. It was just a small mistake. But HMRC doesn't look at things in isolation. It looks at the bigger picture. So let's break down the most common patterns that show up. Late VAT payments, delayed PAYE, returns filed late. Figures that don't quite line up across different filings. Now on their own, these things happen. But when they start repeating, that's when it becomes a pattern. Let's say over the course of a year, VAT is paid late once, PAYE is delayed, then another return is filed late. Individually, not a huge deal, but together, it starts to suggest something. Usually, cash flow pressure. And that's the key. HMRC isn't making a judgment about you as a person. It's just seeing a pattern in the data. Another simple example. Turnover is going up, but the director's income is low, and tax payments are inconsistent. That combination doesn't quite add up. So the takeaway here is, it's not about being perfect. It's about avoiding repeated issues that build into a pattern. And here's the bit most people miss. These patterns build quietly. There's no alert, no warning notification. It just builds in the background. So by the time a letter arrives, it often feels sudden. But in reality, it's been developing for months. That's why staying consistent month to month matters more than just fixing things at year end. Because HMRC isn't just looking at your accounts once a year anymore. It's looking at behavior over time. Here's a much more relatable example using VAT. Let's say your quarterly VAT bill is around £8,000. In quarter 1, you pay late by a couple of weeks. In quarter 2, you file late and pick up a penalty point. In quarter 3, you're late again. And now you're closer to the penalty threshold. Under the UK VAT penalty points system, which depends on submission frequency, 5 points for monthly, 4 points for quarterly, and 2 points for annual returns. Once you hit the limit, you can start getting financial penalties. So now it's not just about being late, it's showing a repeated pattern of late filing and payment. From your perspective, you've just had a few tight months, but from HMRC's system, it looks like ongoing compliance issues. Now add one more layer to that. Let's say your turnover is increasing, but you're still struggling to pay VAT on time. That can suggest that money is coming in, but not being managed properly for tax. And again, that's what creates a tension. So the takeaway here is, it's not about one mistake, it's about the sequence of events. Because once that sequence starts forming, that's when your risk profile begins to change. Now onto the third point, time to pay. Helpful, but only if it's realistic. And this is where a lot of directors feel like they're doing the right thing. You contact HMRC, you explain the situation, you agree a payment plan. And in many cases, that's exactly what you should do. But there's something important to understand. That plan becomes part of your history. So if it works, great. But if it doesn't, that's where problems can build. Let's walk through a typical situation. A company owes £24,000 in VAT and corporation tax. They agree to pay £2,000 a month over 12 months. But realistically, after wages, rent, and suppliers, the business only has about £1,200 spare each month. So what happens? Month 1, paid. Month 2, tight, but paid. Month 3, they miss it. Now they still owe over £20,000, and they've broken the agreement. From HMRC's perspective, there's a debt, there's a plan. And the plan hasn't been followed. That's when things can start escalating. So the key point here is simple. When you set up a payment plan, be realistic, not optimistic. Base it on what the business can actually afford. Because a realistic plan helps stabilize things. An unrealistic one can make things worse. Here's another practical example. Let's say your business makes around £5,000 a month in profit before tax, but your time to pay is set at £3,000 a month. That only leaves £2,000 to cover future VAT, PAYE, and any unexpected costs. So even if nothing goes wrong, you're already under pressure. And in business, something always comes up. So when setting a plan, ask yourself, if nothing goes perfectly, can I still afford this? If the answer is no, the plan needs adjusting before it becomes a problem. Now let's talk about something that often goes under the radar, directors' loan accounts. This is one of the most common areas where issues develop slowly. It usually starts small. You take a bit of money out, then another transfer, maybe a personal expense, goes through the business. Nothing unusual. But over time it builds up. Now on its own that's not necessarily a problem, but it becomes one when it's combined with tax pressure. So let's break it down simply. The company owes HMRC money. At the same time, the director has taken money out. Let's say the company owes £35,000 in VAT and corporation tax, and over the year, the director has taken £30,000 through their loan account. From their point of view, it was just drawings to live on. But from HMRC's side, it can look like money has been taken, while tax hasn't been paid. There are also tax rules to be aware of. If that £30,000 loan isn't repaid within 9 months after the year end, the company may face a Section 455 charge, currently 35.75%, so that could mean an extra tax cost of over £10,000, even though the money has already been taken, and if the loan goes over £10,000, there can also be benefit-in-kind implications. So this is where it starts to stack up. Here's a very simple scenario. A director takes £2,500 a month out of the business. Over a year, that's £30,000. But the company only made £15,000 in actual profit, so the extra £15,000 is effectively a loan. Now combine that with a tax bill that hasn't been paid, and you can see how quickly this builds into something HMRC might question. So the habits here are key. Track it monthly, know your profit, and don't rely on "I'll handle it later," because later is usually when the pressure shows up. Now finally, let's talk about something a lot of directors believe. Why being small doesn't mean you're ignored. We're too small for HMRC to care. This is usually an easy assumption to make, but in reality, that's not how things work anymore. HMRC isn't focusing on size, it's focusing on data. And systems don't really care whether your turnover is £50,000 or £500,000. They care whether your information makes sense as a whole. So what actually matters? Consistency, accuracy, and timing. If your filings are consistent, your numbers line up, and your payments are on time, most businesses don't run into issues. If those things slip repeatedly, that's when attention increases. Here's a clear comparison. Business A, turnover £60,000, files VAT late twice, pays tax late twice, has small inconsistencies in filings. Business B, turnover £600,000, files everything on time, pays everything on time. Numbers all align. Which one looks higher risk? It's Business A, even though it's much smaller, because the system isn't looking at size, it's looking at behavior. Another simple way to think about it, if your numbers tell one clear story, you're usually fine. If your numbers tell different stories depending on where HMRC looks, That's when questions start. So the final takeaway here is simple. Don't rely on being too small. Focus on being consistent. Because in 2026, consistency is what keeps you off the radar. So the final takeaway here is simple. Don't rely on being too small. Focus on being consistent. Because in 2026, consistency is what keeps you off the radar. So when you step back and look at all of this, you start to realize something important. Most HMRC issues don't come from one big mistake. They come from small things repeated over time. A late payment here, a rushed submission there, a number that doesn't quite match. And on their own, they don't feel serious. But together, they start to tell a story. And that's really what this comes down to. HMRC isn't looking at you personally. It's not about whether they like your business or whether you're a good or bad operator. It's about whether the story your numbers are telling makes sense. If everything lines up, returns are on time, payments are consistent, most of the time, nothing happens. The system just moves on. But if different parts of your financial picture start saying different things, that's when attention builds. And that's why this can feel confusing for a lot of directors, because from your point of view, you might feel like you've done nothing wrong. You've been busy. You've been dealing with cash flow. You've been trying to keep things going. And that's completely normal. But the system doesn't see intent. It sees patterns. So the real takeaway here isn't about being perfect. It's about being consistent, keeping things simple, keeping things aligned, and dealing with issues early, instead of letting them build. Because the earlier something is addressed, the easier it usually is to fix. Now, in terms of expectations, not every late payment leads to a problem. Not every mistake triggers an investigation, but repeated patterns do increase risk over time. So it's less about worrying and more about being aware, and just building better habits going forward. And just to say, everything covered here is general guidance based on how these situations typically work in the UK. It's not specific advice for your circumstances. So if you're ever unsure, or something doesn't quite feel right, it's always worth speaking to an accounting professional who can look at your exact position. And if you found this helpful, make sure to subscribe, because the more you understand how HMRC actually works, the easier it becomes to stay in control and avoid problems before they start.